Now, this is my $1 million bet. This is our actual brokerage account statement. The latest period, it had $1.07 million in it. This period has $1.1 million in it. So what I do, what I'm teaching you now, is we do with a little bit of pretty serious money. And the reason I show this is I don't think you've ever seen this before at any presentation. Somebody saying, hey, we do it with $1 million. This is not something we do hypothetically, or I think this might work out. Louise and I put serious money in this. That's how much I believe in the program. And it's really simple to do. And we're about ready to buy stocks, so we'll be looking at how we're going to buy those stocks today. So this is my $1 million bet, and this is as easy as pie to do what we do. Almost lunchtime, isn't it? Oh my gosh. This is our rule. We're going to buy the 5 lowest priced stocks with a positive 12-month forward PE. Is that too complex? That's really easy, isn't it? Question?
Did you say lowest price being price to sales?
No, lowest priced. Lowest priced stocks.
Like just
The lowest priced stocks, that's it.
So we start out with
In the Dow, we're going to start with the Dow. We'll go through this. We'll rank the Dow. You'll see us do it after lunch. We'll rank the Dow by prices. We're going to find the lowest price stocks in the Dow. Then we're going to look for the ones with a positive 12-month forward PE. They've got to be making money in the future.
that is my second question. Why would a low 12-month forward P seem like it would be high?
High is dangerous. High PEs mean that the price to the earnings is very high. We always want low PE ratios.
But if the current PE is 10 and the 12-month forward is 15, it means the price should be up or the earnings will be down. Which one?
No.
I'm confused.
No, okay, let me try to help with the confusion. What I'm looking for is the low price stocks. We know they outperform the market, right? And I want them to have a positive forward PE. I actually don't care if that's a high or low PE. But in that low price stocks, because the law of square root is so positive, I just want to make certain that they're earning money. It could be a high PE, a low PE, but we actually aren't saying they must be a high PE or low. We're just saying positive PE. So there's just really 2 rules to the selection here. I'll go over it again. We're going to buy the 5 lowest priced stocks that have a positive forward PE ratio. Because you can have low priced stocks and they're not earning money in the future. They're not projected to make money. We don't want those. Those are not a good deal. We've seen those and they fall apart. That's all there is to it. Simple enough? Wow, that's really easy. Please.
How long do you hold it, or do you roll it over every 3 months or quarterly? How often do you?
Oh, now we get into the details. How long do we hold this stuff? What do we do with it, right? Next slide, if you would, please, Harry. Our rule is to buy the 5 lowest priced stocks with a positive 12-month forward PE. That's our first step. And the second step is you can handle it in a variety of ways. You can buy stocks the last week in October because there's a seasonal rally usually in October, or a little sooner if you think you're getting close to buy. Hold for 6 to 9 months, unless you see a anxiety index says we should sell and get out. Years ending in 5, you probably want to buy and hold on all year long. So there's some general timing rules, but let's get specific with those, and I'll show you the actual result of a timing rule. Here is if we buy October 25th and hold for 6 months. And what we're looking at is the Dow itself is down here in red. If we're going to buy, the very top is what you're interested in. We're going to buy in October, sell May 25th. The positive forward PE, the lowest closing price with a positive forward PE, beats everything. But we're timing this. We're buying in October and we're getting out in May. The advantages are this, in the crash of 2009, only went back to here, whereas stocks went back like 12 years. They declined that much. So we avoid the declines. Our rate of return can be substantially higher doing something else. But if you want a smooth equity flow, that's what you want to do. To make it mechanical and really simple, we're going to buy around October 25th, hold it for about 5-6 months. You can put a little timing in on that. We've got to do it mechanically, of course, with a computer. So we're going to get out in May and then move to cash. And the best group to do that with is going to be the 5 lowest priced stocks with a positive forward PE. that beats the market. There's the market down there. There's our return up there. Substantially outperforms the market. And you don't get beat up when the market gets beat up. So that's the simplest way of doing it, but you will not be fully invested and you will miss some big up moves in the marketplace. But that starts to answer the question. I forgot who asked the question about what do we do with these stocks. That's one answer to what to do with these stocks.
So do we have stop losses then?
No stop losses. Why don't I use stop losses? Because we're a value player, right? We don't care. We're in a group of 5 stocks, so we have our own little average. This is my big breakthrough in understanding how to beat the market. It's like everybody else for years, I tried to find the strongest stocks, the hottest stocks, right? But I don't know what your experience is. The hot stocks I bought usually turn cold. Has anybody had that experience?
Oh, yeah.
Oh yeah, right. Yeah, everybody. Yeah, we know about. So one day I go, well, what if I just looked at the Dow and bought all the stocks except a couple of way overvalued stocks? I beat the Dow, right? If I buy 25 stocks of the 30 that are low valuation, leave the turkey stocks out of there, I beat the Dow. Well, wow, that's a remarkable thought. Quit trying to chase success. Let's find failure. It's a lot easier to see ugly people than see beautiful people. Like they just stand out, right? So it's pretty, I thought, gee, that's a novel thought, Larry. But the problem was, how am I going to buy 25 stocks? That's a lot of money. So, well, let's just buy 5 stocks. Buy the 5 best value stocks in the Dow. That performs my own little average. I won't need stop losses. And when I first started doing this program years ago, it's been 18 years now, first started doing it, testing it, my broker called up some stocks had gone against. Oh, what about your stop losses? You know what, Bob, there's no stop losses in this. I'm in an average because I believe in upward drift. I believe that these stocks will eventually get rewarded. Sure enough, they came back, we got out. He said, wow, that was pretty interesting. You know, everybody else, you know, the market came down, they got stopped out. So no, I'm in an average. I believe in upward drift, and I believe that it'll be rewarded at some point. So no stop losses. Obviously, you may change out a little bit, but since I'm buying value, I'm really not concerned about the stop loss in it at all. It makes it a lot easier then too. You never get stopped out.
There's another place to go back to those like decennial,
Pardon?
those year things.
Yeah, now you can do a lot of things with this basic strategy that I've taught you. You could obviously say in a year like now, I want to hold through May, or you could use a decennial pattern to say we want to get in or out, or the anxiety index is high or low. Sure, you can use that for longer term timing. I'll talk a little bit more about that, but you could time your performance and you will do better. But for people like my doctor friend in St. Croix, he didn't want to do anything. He just wanted to be fully invested all the time. We'll get to the easiest way to do that in a moment. And there was a question here. Did I hear another question?
You're
Yes.
applying these rules for the blue chips, as you said?
I'm sorry?
You're applying these rules for blue chips?
I'm applying these rules for the stocks and the Dow Jones Industrial Average. You probably could do it in the S&P 500. I've never tested it, but I don't see why there would be any difference. It might be actually a little bit better, because I know the law square root is really important. That law is just so, it's like the law of gravity of stock prices. And I know 12-month forward P ratio are really important. Federal Reserve told me so. How do I know? The Federal Reserve told me so. So sure, it's a winning combination. But you want to be in blue chip stocks.
At the beginning of the presentation, you mentioned about different groups. Some
Right.
of them are more profitable than others. So do you make any selection here based on groups, or just these rules, just the index and that's it?
So the question is, I think, can we carry this on to another group of stocks? Sure. If you wanted to be in the healthcare stocks, I do the same thing. Find the lowest price stocks in the healthcare stocks that have the positive 12-month forward PE. That'll outperform the health group stocks on average. So you could take the exact same scenario, the exact same rules, apply to any group you want to. First, screen the lowest price ones, then with positive forward PE ratio, that's your group to buy within that industry. Way in the back.
What data are you using for your 12-month forward?
What data am I using for the 12-month forward PE? I'm going to show it to you in just a moment, called FinViz. Do you know FinViz? Yeah. Great, isn't it? Oh, remarkable. What a godsend for us. So that's what we'll be using. And we use the Thomson Reuters data in the testing that we do, because quantitative analytics is bought out by Thomson Reuters. Question?
Yeah, you had a stock webinar earlier this year where you talked about the increase in yields as something that you look at, and you showed some results. I'm wondering how these results compare to those results. And if
Yeah,
you showed
well,
them-
let me finish the presentation. We'll get to it all. Please.
Jonathan, question, how does this relate to other stock markets in other countries?
How does this relate to other stock markets in other countries? I haven't tested it. And I don't like to answer things unless I say, I've done the test, I know what the data shows. I don't know. But when we lived in Australia, I kept a group of their low-price stocks in the SPYs, their index, and they looked to me like they outperformed. It just makes sense. It's like logic, right? They're low price, so the law of square root works on anything based on price. There's such basic rules. Yeah. Because the low price stocks in the blue chip average. Now that's the critical point, not just any group of low price stocks, because there are a lot of junky low price stocks. And there's no desire by funds to buy. But funds have got to buy, mutual funds, hedge funds, have got to buy stocks in the Dow. That's on their shopping list. So where are they going to buy? Low price stocks. What are the stocks going to buy? Stocks with positive forward PE ratios or low PE ratios. So sure, it makes sense, it should work. I just haven't done the data on it. I apologize.
Larry, can you go back to the forward PE ratio though? You also noted that it was both of them to be the lower.
Yeah, the lower the better. But for this simple test, we just looked at low price with positive forward PE. You could take it one step further and say I'm going to buy the lowest price stocks with the lowest PE ratio. But that's a third step. And I don't know, Marisa, some of these people can handle a third step in this room. So just two steps.
I understood it properly.
But you could do, yeah, so, I mean, we're gonna do 20% a year with this, like, that's good enough. We might get it to 21% by advancing it a little bit and optimizing. I'm not gonna do that.
Have you said those with negative 4 PEs usually go down typically?
Typically, a stock with a negative forward P will go down.
Can you hedge, do a long short?
No, now you're getting, now he wants to go long, short, strip, strap. Look, I'm 73 years old. I can barely get out of bed in the morning. I don't want to worry about butterfly spreads. I just want to have a simple investment program. You could, yeah, but I'm going, I'm happy. Please.
As it says, forward PE data are forecasts made by analysts. If meantime, during the year, this forecast is changed drastically, that means that you exit from that position, or what's the scenario?
So the question is, well, gosh, Larry, these are forward results, and they change during the year. They do, so we're going to take advantage of that. I'll show you how. Well, what if we do this? Here's the Dow Jones average down here, the red line. Look at that green line up there. Did it do better than the Dow? Oh, yeah, by a whole lot. That's 20% a year. That's about 11% a year. It more than doubles the performance of the Dow. And all that we're doing is we're going to buy the 5 lowest close, positive forward stocks in the Dow, and we're going to roll that position every 3 months. Because earnings change and prices change. And think about this. If we buy a low price stock, it's in the lowest 5 price stocks in the Dow, it moves out of that low price stock group. What do we have? A profit, right? It's not in the group any longer. So we'll exit that one and buy whatever stock is now in that low price group of 5 stocks in the Dow. So we'll blow one out and add another one in. And again, we're going to look at the current revisions in the forward PE ratios to see if there's been a change. And we'll look at that to help us update that model every 3 months. We're going to do that.
Now that data is generated off of by October 25th?
No, this data is buy off of the first of the month, the first of the year.
Okay, quarterly.
Quarterly, yeah. So this just first of the year, every quarterly. This is what we're going to do. Hold on, a lot of questions. Please.
In position the whole year?
Pardon?
The whole year long?
The whole, yeah, we'll hold until the end of every quarter, like September. This is the end of the quarter. So I've got to roll out maybe of my 5 stocks. We'll look at those today. Yes.
We're not counting tax implications.
We're not counting tax implications, no. Because most of you probably are in a 401 defined benefit program, whatever. Or even if you're not, you're getting 20% of your money, you got to pay taxes, move out of California. Unbelievable. Yesterday, I was such a kind husband, I bought Louise a sandwich for lunch. The tax on a sandwich and a Coca-Cola, 89 cents. It's like $1, almost for the taxes. I was like, how do people live in this state? Oh, no wonder people are moving out. No water and high taxes, a good reason to go some other place. A lot of water in St. Croix.
Nice weather, too.
Yes.
So while you're doing this, you don't care about all the other indexes which you described in the first recession, this and that?
No, I care about the other things. If I'm doing this and the yield curve starts to come down like it did, we saw in 2008, I probably wouldn't want to be in stocks, would I? So I go, okay, I'm out of stock. Then, remember the 13-week rate of change gave a buy signal down about here, so I'm now long stocks. And I've been long stocks ever since. No recession, no yield curve, none of the stuff set up as a sell signal yet in the marketplace, so I'll still just do my little game here. But sure, you can adapt this as you see fit. If you get really bearish because you bought somebody's newsletter and he's an end of the world type of guy, well, then you could get out of your stocks and you're probably going to sell your stocks right about there. Or maybe you'll sell your stocks there. But the only reason it's going to get me flat is one of my recession indicator sell signals, yield curve, et cetera. Something really demonstrative's got to get out of stocks. Other than that, just continue doing this program. Upward drift. I get upward drift, don't I? In the best stocks in the world, the stocks in the Dow Jones Industrial Average that are low price and have a positive forward PE ratio. What could be better? I thought I saw another hand up with a question. Yes?
What was the dogs of the Dow? I
The
was like,
dogs of the
20
Dow
years ago.
are an interesting group of stocks. The dogs of the Dow is a strategy that buys the 10 highest yielding stocks in the Dow on the assumption that mutual funds would like to buy stocks with high yields. And the dogs of the Dow usually beat the Dow, but not always. If we look at the dogs of the Dow versus our performance of what I've taught you, the dogs of the Dow strategy is going to be about in here if we bring that line on out. It'll have ups and downs, obviously, but it'll be about here. Nothing. It, on average, is like, from memory, maybe 14% a year, whereas we're doing 20% a year. It doesn't do nearly as well. Of all the stuff I've worked on, what I've shown you is the simplest to get a 20% rate of return. There's another little advanced formula, but maybe there's a 1 percentage point difference. Why? This is just easy enough to do. Yes, please.
You trust 12-month forward PE and the cheapest stocks over comparative strength when you go to make your selection of the 5?
So the question is one step beyond where I've gone so far. We can use comparative strength to also find stocks. I'll talk about that in a little bit. But right now, this is the simple strategy. All I want you to get in your head is 5 lowest price stocks, 12-month forward PE, that's it. That's all this strategy is. That's it. We're done. It's over. Now, we can do all these fancy things. We'll look at that. But right now, for the most people, that's all they have right now. The ideal would be to buy October 19th. But for our test purpose, we just do this on a yearly basis, continuing to roll it forward. And the way we actually trade it, we've just been long this, and we'll continue to be long until we get a recession sell signal. Or whatever sell signal, but in the meantime, we're going to be buying new stocks the 1st of October based on this strategy. We'll look at those in a little bit to see what stocks Larry and Louise are going to be getting into and out of.